Thanks for being here. I'm excited for our next panel focused on the world of investing in FinTech. As you know, there's a lot happening nowadays and there's a lot of talk. I'm excited to invite my two panelists to the stage. We'll start with Tarana Lalwani. Tarana, if I can have you on stage, please. Tarana started her career in the US with Morgan Stanley, joined financial services firm Radian, and she's been back in India for a while, first with Seed Fund on the equity investing side, doing early stage, and she's currently a partner at InnoVen Capital, which is a well-known Indian and Southeast Asian venture debt fund. InnoVen was founded in 2008. It's invested about $1 billion across 200 companies. They have multiple funds, but Tarana works and leads the Indian fund. Their portfolio companies in the FinTech space include companies like BharatPe, MobiKwik, mSwipe, FreeCharge, Slice, and they're also an active investor in across sectors. Welcome, Tarana, and we look forward to chatting. If I can also invite Shashvat. Shashvat Rai is here with us from Aavishkaar Capital. Shashvat has spent most of his career at Aavishkaar Capital, which, as some of you know, is impact-focused and one of the long-standing impact-focused funds. He personally has co-led investments in companies like Checkbook, FinancePay, and Cloudwell. And he's also worked with other portfolio companies and co-led investments in Utkarsh, Suryoday, and R1. He has a BTech from IIT Bombay and an MBA from ISB. And for those who don't know Aavishkaar was founded in 2001. Everybody talks about impact nowadays, but Aavishkaar has been around a long time. I interact with global LPs who do know Aavishkaar and the work Aavishkaar does in India. They're now on fund number 7, as far as I know. And 3 of the companies they've seeded are now on IPO stage and very, very focused on financial inclusion, among a few other areas. Welcome, Shashvat. So I actually, we're lucky with this panel because we have two panelists that come from interesting business models that is talked a lot about today. Tarana represents the venture debt side. For those who've been tracking the space, obviously venture equity has been around and talked about for a long time. But there's a lot happening in venture debt, and the business model is different, and we're excited to hear from her today. And obviously, everybody is now talking about impact and ESG and financial inclusion, and Aavishkaar has been doing this for a long, long time. And so that's the second interesting business model that we'll kind of explore today. So I want to actually start with the basics for people in the room who would like to be enlightened. Maybe with Tarana, if she can give us, I requested her to give us just a bit of a crash course on kind of venture debt, what the model's like, briefly what made you move from venture equity to venture debt, and what all the noise is about. Because nowadays, a lot of the deals that get announced, there's a debt component and there's an equity component. And so we'd love to just get a bit of a crash course. Yeah.
Happy to start. So quickly, venture debt is, it's actually been, I mean, I'm sure everyone read about Silicon Valley Bank a few weeks ago. It's been around actually since the early 1970s. As Sahil said, we were Silicon Valley Bank, and then in 2015, Temasek and UOB acquired the business and we rebranded it as InnoVen. So we are the oldest player in the country. Now, how venture debt works, and I want to clarify this for everyone to start off, it's not a bridge loan. So a lot of times people think it's a bridge loan between 2 equity rounds. If I had to put it plain vanilla, venture debt is a top-up to one's equity round. What happens, a lot of these startups are loss-making businesses. They don't have hard assets, so they don't qualify for traditional debt. That's where venture debt plays a role. We say, okay, you know, and it's, of course, it's debt, so it's less dilutive source of capital. We come in, we like to come in as a top-up to the equity round. So companies raising 5 million, they don't want to, they don't like the valuation. So they're like, okay, maybe I take 4 in equity, 1 in debt. Or on the flip side, you want to raise 5, but you're getting interest for 4, but you believe you need 5 million, you know, to get to X milestone. Or some companies, we have a lot of brick and mortar models that have a working capital cycle or a capex expense. It makes sense to raise some in debt and use that for your expansion versus equity, because equity is relatively more expensive than venture debt. Venture debt's usually a monthly amortizing loan over a 2 to 3 year life period. It's as I said, it has a coupon. We have a tiny warrant kicker or an equity kicker that we say where we'll take 10% of the loan amount as warrants. So the way to look at it is you're diluting 10% for that same quantum that you would have diluted in equity, which is why we say for stakeholders, it makes sense, they dilute less. So if you believe you have an upside to your business, it's sort of a no-brainer. It can help with accelerating your business, experimenting. For example, like Byju's used us when they were doing the Shah Rukh Khan ad. Now, they had money in the bank, but you go and tell your equity investors or your board that, hey, I'm going to go burn 50 crores in 1 month. Everyone's going to roll their eyes. So they decided they take it in debt and amortize the payments and, pay up front for that ad, get the discount that they were getting. And then, of course, we know what that ad did for them at that time. So there are different use cases. Acceleration, it can be used as an insurance policy. In this environment, a lot of companies believe they should raise a little extra. Also, as I said, it's non-dilutive. So a lot of companies now actually are getting a lot of interest. A lot of guys are coming back and saying, we don't want to dilute. Do we take some debt? And you have to balance that out because I always say, after all, it's debt. It's serviceable. I expect to get this repayment, unlike equity. And it's, so because it's debt, I can't afford mortality, but because my upside is capped. So that's the balancing act with venture debt. That said, it's been a great asset class. The returns have been phenomenal, no complaints, touch wood. And now what was your second question?
What made you move from the equity side? Because we were talking before this outside, and Tarana was telling me that the equity side was also a lot of fun.
Yeah.
So
I'll come to that.
Yeah.
That's also, just coming to you, actually, the other question you asked is the momentum that
Yes.
debt is getting right now. I think it just shows maturity of the venture ecosystem. Initially when I joined, or even a few years ago, you had to educate founders and stakeholders about what this product is, what's the offering, what's the value add. Now with second-time founders, people, having been part of I'd say the equity ecosystem for the last 15 years, there's a lot more awareness. There are other players in the market. People are seeing the use case. They're seeing the value of it. And so it's a lot more sort of acceptable. And the other interesting part, actually, to point out to venture debt is unlike equity where you will have Series A investors, growth investors, late-stage investors, we're sort of sector agnostic and stage agnostic. So we come in generally in a Series A and we can play through the gamut. So we start with something small with the company, maybe $1 million check. And then as the company grows, we can do more debt in the company. So our range goes from $500,000 to $15 million. So that's sort of the other sort of, I'd say, peculiarity to venture debt, that we have the ability to play through stages. And lastly, because we're sector agnostic and we don't take board seats and we're debt, we also sort of get a bird's eye view of, we can be in 3 different companies. There's no conflict of interest. So it's an interesting asset class from that perspective. And lastly, and then I'll come to why I moved. Also, one other interesting aspect to this is that you can, where on the equity side, you'll do 2 transactions or 3 transactions a year. Here we do like 10 to 15 transactions a year. So it's more fast-paced. Why I moved from equity to debt? I still think early stage equity is very interesting. I always joke, I don't have a great idea, so others I'd be a founder and build something great. So the next best thing you can do is work with founders. And on the early stage equity, I enjoyed my time at Seed Fund, literally working with founders. And I'm sure Shashvat felt the same way, where literally one of our companies deciding the color of the brand and, getting involved in hiring, doing the interviews for them, or what should we be charging clients where we come across as premium or mass premium. So it's an interesting place to be. On the debt side, you do not get as involved. But again, it's how, if you have a good relation with the founder, you have that rapport, you can. My brutally blatant answer was that when I would have continued at Seed Fund, they were not raising another fund, and there was a parallel move. you have to sort of be selective. You don't have your options. So I moved from equity to debt. Having said that, debt, as I mentioned, is very interesting from the aspect that you get to see a lot. You do a lot, you see a lot. Like I've invested in 6 or 8 logistic companies. So I get to see very different models, similar models, and then be able to compare them, analyze them. So you get this sort of really deep understanding of a sector or a segment because you get to see so much in that one sort of business sector. So I think that's the interesting part of it. Hope
Thank
I
you.
answered all your questions.
Yeah, no, thank you. I think that was useful. Shashwat, similar, I guess, question, but for impact, right? Everybody's talking about impact. It's all over the place. There are requirements and forms being sent around. People like you and Aavishkaar have been focused on this cause of serving the underserved, investing in companies that serve the underserved, financial inclusion for a long period of time. So in a way, at least in India, you defined kind of what's happening in the space. So how, as Aavishkaar and as you, do you truly define impact investing, and what are the guidelines around impact?
Sure. Thanks, Sahil. First of all, thanks for the invitation. Very pleased to be here. So I think, in terms of the evolution of impact investing, one of the vantage points for Aavishkaar was that our founder is actually a forester. So he doesn't come from the typical, MBA background or finance background. He was a forester, and he realized that, if you direct capital to rural areas or underserved segments of society, there are still some viable business models which, if they are supported by risk capital, then they can scale. And by virtue of you being investor in those enterprises, you can also, make a business out of it. So it was a very primitive thought back in 2001, 2002, where he wanted to experiment with a lot of different kind of sectors which are dealing with underserved segments. And natural, the top of the mind comes is, areas such as handicrafts or farming, right? And financial inclusion, microfinance. So these are all some areas where hardly anyone else was looking at it, and we started taking bets. Our initial bets were very, very small. The check sizes used to be $50,000, $60,000 at that time because we didn't have money. It took us around 6 years to raise our first $1 million, which in today's day and world, if you ask a fund that if you took 6 years to raise $1 million, people will laugh and say what you're doing, right? So, but because it was such a novel concept, so it required a lot of perseverance. But come 2007, some of these bets started showing a lot of promise, and we got institutional investors who started backing us. And since then, if you fast forward from 2007 to 2023, today we manage about $500 million across 8 funds and investing across South Asia, Southeast Asia, and Africa. But one of the core things which has always stayed with us is that, we always try to identify the mission alignment, right? That's the main thing. And when you talk about mission alignment, it's very hard to put frameworks around it. So we as Aavishkaar team don't like a lot of forms with a lot of data sitting in it. We are more concept oriented. We try to see, if a particular business model grows, who is the underserved segment which is getting benefited by that. And it's like a value chain participation, right? So underserved segment can either be a producer and a supplier to your business model. It could be a consumer of your business model. So if you are offering affordable products and services, it could be a consumer of that. Or it could be a value chain participant where it's actually enabling the ecosystem of the business model. So across the value chain, there are places where underserved segment can actually come in and contribute. And you can see today, if you look at not just our portfolio, but in general, any impact investors portfolio, you'll realize that, that has led to some degree of sector identification over a period of time. Agri is one of the large sectors. Financial inclusion is the second largest sector. Rural oriented models are probably the third, fourth largest sectors. Last mile logistics. There are so many areas in a developing economy, because of the kind of population income pyramid that we have, invariably you will find very significant share of models fit in impact investment, which is, kind of a breaking the myth kind of a statement. People generally like to think that most deals are pure play commercial deals and not impact deals. Basis my 11 years in this sector, I've realized it's actually the other way around. We live in a poor country. We live in a country with fractured infrastructure. So private sector entrepreneurs who are solving for problems are invariably affecting a very significant chunk of the pyramid, population pyramid. And hence, many models are geared towards making impact. We just try to be somewhat selective about, the degree, quantum of impact that we want to stick with. But I think even the mid-market venture capital funds, you'll see, if you carefully analyze, a lot of their investments are impact investments. So it's a very broad asset class. It has this perception of being a niche asset class, but it's actually fairly broad.
If I can ask, since a lot of the people here also represent banking technology and banking infrastructure, because we're setting up a FinTech fund, I've been talking to LPs who are primarily focused on impact, and for them, banking infrastructure, banking technology is not impact, right? And the conversation ends there. How do you, because you said that the definition is broad and it can technically, banking technology then serves retail, and then there are people getting access to the innovation. Does that fit into your definition of how do some of these people in the room fit into that definition?
See, what we have, so we have got, if you look at pure play B2B models, right?
Yes.
Where a particular FinTech partner is just developing things for the bank.
Yes.
If the use cases are actually enabling access, a very broad access to a wide segment of population where the status quo solutions are not able to reach there, it's definitely an impact. It's like a levered impact kind of a case for us that, if this technology goes through, the accessibility improves or economics improves, whatever is the argument around it. But you are right. There is still a significant share of banking technology solutions which will not fit in the classical definition of impact investment. On the other hand, if it's a B2C kind of a model, there is a very good chance that it will fit in the impact investment mandate.
Okay. If we can talk a little bit, Tarana, about, I know InnoVen does cuts across sectors, but just how you, because the definition of FinTech is getting blurry, and some people define FinTech as banking technology, some define it as just what's happening on the B2C side in personal finance. How do you and InnoVen look at your broad framework of what fits within FinTech? And then if Shashvat, same question for you when she's done, and then if you can talk about kind of what extra metrics you have when it comes to looking at B2B versus B2C, because there's been a lot of is it a myth? There's a lot of talk about business models and unit economics being far more feasible and cash burn being less intense. And how much of that do you believe and truly believe, and how much of that do you think is just talk?
Well, I think FinTech is a little bit of a blur between banking and FinTech. Actually, I wouldn't even call it FinTech. I'd say the way to we look at FinTech or we classify as FinTech is anything that's technology enabled. And if I had to make a spook, it's where they're burning money versus actually building it the profitable way. So it's interesting. You'll see, there's lending, right? One aspect of FinTech is lending. Now you have NBFCs who start off day one, profitable businesses lending. Then you have someone who puts the tech angle in, still lending, but are sort of their CAC is higher. So that's a joke we make internally. Yeah. But jokes aside, I think as a broad definition, anything, the word tech, the fact that it can be tech-enabled is considered FinTech, where we consider it's a new economy business. And coming from venture debt or from the venture ecosystem, anything that is venture fundable, where we believe it can get to a large scale. And it's sort of disrupting financial services is defined as FinTech, if I had to broadly put it, but it is blurry. And that's how we sort of define it. So you have businesses, I mean, anything can be FinTech, lending, payments, even, B2B technology products like a Lentra or a Perfios, which provides some sort of banking technology, technology to banks. Then there's, of course, under FinTech, InsurTech, Wealth Tech. So it's a broad category with lots of pieces to it. And then, of course, on the lending, there's consumer lending, personal loan, BNPL, B2B lending. There's also companies that are doing vendor financing, supply chain. So those are part of the FinTech. And then if you really wanted to get broad, I think a lot of the B2B businesses end up doing a lot of financing for other businesses.
Yes.
So that could also classify in a skewed way.
So it seems like you,
FinTech.
I guess you're not biased towards B2B. I think you're open-minded.
No, we're open.
Yeah.
We look at the business, as I said, from a venture debt perspective.
Yeah.
When I'm looking at a venture, if I should be lending to a company, there are a couple of things I'm looking for criteria. Is it a business that can scale up from a debt perspective? Where do they have cash flows? In the sense that, does this company have enough runway for the next 12 to 18 months? And are they backed by a venture fund that I can draw comfort from for the DD and governance piece? Because I don't take board seats.
Right.
And then on the equity side, similar to what Shashvat would do, is quality of founders, business model, are they market leaders, regulation, and those aspects. But FinTech is broad.
Shashvat, do you guys have a...
Yeah, so for us, obviously, the top of the mind models are always B2C in some form or shape. I mean, B2C, when I say it will be either a retail individual consumer, which is like a mass market consumer, which is not getting those range of services. It could be lending, it could be insurance, it could be liabilities products. In some cases, it's MSMEs, right? So we also say, I mean, in some sense, MSME is also kind of a B to small b or B2C, whichever parlance you want to use. So most models that we have evaluated in fair amount of detail and depth is lying in this B2C or B to small b kind of a zone. The classic B2B, we have looked at some models in the past. And wherever we felt that there is an ecosystem advantage coming in, right? For example, some of these companies which are coming up like Perfios, I mean, these are ecosystem enablers. Because of a company like Perfios, a wide set of financial institutions, whether it is FinTech, whether it is conventional FIs, are having a very unique advantage, right? It's like a toolkit for a very specific item for which you don't have to build things in-house. So that is the mind frame that we use for, the B2B evaluations.
Got it. It's two people I mentioned Perfios. I don't know if there's anybody from Perfios here. I know they attend some of our events, but shout out to them. And then if I can further ask you, Shashvat, in terms of, obviously, banks are doing their best to get to the bottom of the pyramid in their own way, maybe slower, maybe structured differently, maybe more rigid. But what do you think some of your portfolio companies or companies you evaluate are doing differently or better or more efficiently? And how does that differentiate them really?
Sure. So let me take a very interesting example, right? The classic dilemma is, for example, the banks wanting to reach farmers in a risk as well as cost-efficient kind of a manner. We have got a company called Argos, which is like a grain bank for farmers. The concept of grain bank is very simple. A farmer, when it's a harvesting season, the grains have the lowest price in the market. So if they sell instantaneously, they end up taking the price disadvantage. So Argos has developed a grain banking with around 200 odd grain banks across the country, where farmers can actually go and deposit even one gunny bag of grain, and they instantly get a grain bank receipt. And they get 70% advance money because the farmers during harvesting season require a lot of capital because they are employing so much labor, there is logistics cost, there are so many things that they have to take care of. in this scenario, and what ends up happening is we have a starting loan LTV of 70%, and when the grain value appreciates, 6-7 months down the line, when the farmer is out in the market selling in the off season, consistently this company has demonstrated 50% uptick in income for the farmer. So our government keeps saying how to double farmers' income. This company has at least reached to that 1.5x level through this model. A bank partnered with us last year, and they, within the first year itself, they disbursed 100 crores with us. And it's a 100% secured facility because the grain is in custody of a company, and that company is also responsible for the market linkage of the farmer. So not a single default has ever happened. I mean, we are operating in a FinTech environment where FinTechs face 25%, 30%, 35% check bounces. This company is giving you a classic PSL directly linked to the farmer with a 0%, 0% NPF. Forget about NPF, 0% bounce rate. So solutions like this exist, right? These are all, and it'll just be a matter of, being malleable, API-based kind of architectures coming in place to integrate with players like this. So it requires a lot of partnership mindset. So all the banks will have to have, I think before this there was a presentation where there was a mention of FinTech lab of sorts, where you try to identify these, green shoot opportunities and try to collaborate with some of these partners who can be your operational partner on the ground. We have another company called Checkbook where InnoVen is also there with us. And they have identified a very unique, cost-efficient way to cater to the shop segment. And they are offering lending, they are offering liabilities, they are offering insurance through a unified stack. And lots of banks and insurance companies have come in and partnered with them. And through them, the banks are able to build their books. The insurance companies are able to do general insurance, health insurance, life insurance sales to a customer profile, which invariably is not their core customer profile. They're completely building out this segment via such partnership. So I think the crux of the issue is how do you find the partners who can actually, who have fundamentals right, and then you integrate with them and build your businesses over and above them. They can be very good experimental grounds for you, and through them you can actually kind of catalyze an ecosystem which was never there to begin with. And banks, I think, have a very, very strong role to play because of the kind of wherewithal they bring to the table, the kind of tacit knowledge also they bring to the table. There is a lot that these partners will also learn from the banks. It's not just a one-way street. It is also the experience of the banking system from which these partners can also leverage. So if that collaboration starts, it can be a very beautiful collaboration.
So actually, that's one of my next questions is how do you measure this partnership, right? Because we talked to, Subit and I spoke to two banks last 2 weeks that said we have every FinTech in India that comes and meets us and we will partner with everybody. And there are FinTechs who value just having an advisor from the bank. There are FinTechs who value having access to capital. There are FinTechs that value having access to data. So what is the right metric for, and this is for the both of you, for this bank and FinTech partnership? How do you weigh that? And apart from the softer aspects?
See, I think one of the challenges I've seen is that, the time to integrate many a times is the first level friction item which needs to be taken care of in one way or the other. Many a times what will happen is if the integration teams are extremely, they are pounded with a lot of requests from FinTechs, that also creates a problem because they can never meet their deadline. And that creates that initial roadblock because of which the partnership is always starting on a very sticky wicket. So that needs to be addressed because I think it's better to first do a careful due diligence, select one or two partners for one or two go-to-market strategies rather than spreading yourself across 5, 7 partners. It's better to spend that time early on rather than getting into a complete experimental zone. So as you rightly pointed out, the yardstick it will be that if you have taken a project integration of say a month or a month and a half, then you try to stick to it. That's the first part of it. And after that, there have to be very tangible kind of KRAs agreed on both sides of the table, which need to be reviewed and measured upon. And that will be a case-to-case dependent kind of a situation. How ready are the two parties? How keen are the two parties? And how much value addition is there on both the parties? So that's a bit of a subjective situation, but all of that should be charted out right up front.
Thank you.
I
Tarana?
don't have much to add. I'll echo his points. And I think it's just about finding the balance of complementing each other and setting expectations. Because I think a lot of times there's a mismatch between what the fintech's expecting and what the bank's expecting.
Right.
And just seeing if they can figure out where. And there's also the regulatory aspect that needs to be addressed in this mix, which sometimes sort of falls in the gray, or one thinks the other can tackle it. And so just figuring that piece out.
Okay. I think in the previous comment, we spoke a little bit about MSME lending and how both fintechs and banks are trying to crack this layer, right? What do you think the answer is? What do you think the secret sauce is? What will differentiate the ones who win from the ones who don't? Is it about how wide their distribution is? Is it about the model under which they underwrite? Is it about the banks they partner with on the back end? If it's a fintech, what do you think is going to differentiate? Is it about the founder and the fact that they've come from a bank and so maybe they'll do better? What do you think the metrics there will be on MSME lending? Tarana, you can start, I guess.
I think it's a mix of everything, but the key thing would be is how you grow your book and the quality of your book.
Right.
I think it comes down to how you acquire your customers, what the quality of the book is, how you grow it, and what your NPAs are going to be at the end. It's simple. Founder quality, what background he or she comes from, tying up with a bank or not tying up with a bank, all those I think are just the catalyst outside of it. This is the main thing when it comes to lending to SMEs. The reason it's a tough segment to lend to is because underwriting it is tough. Yeah. And building that there's a certain segment of it that is credible and others are not. So how do you sort of expand, how do you grow that pie that you can underwrite the next level? Because a lot of times we think, if we can price that. But what we see is like you think you can price it, but that loss ratio goes up a lot more significantly. So I may think, okay, chalo, if I go after this next segment and I increase my yields by 5%, it will cover for the losses, but that's not true. So I think it comes down to key of underwriting and execution of it.
And is there a segment of that?
Sometimes I think our banks are smart. They know what they're doing. We can dismiss and say, they're not lending. There's a reason they're not lending to that segment.
So is there a segment, if you sit down with a company you're evaluating that is focused on MSME lending, is there a segment within that MSME that makes you nervous as an investor?
Honestly, we're not the experts over there, right? Yeah. We look at it as the quality of the book. Purely, what are they executing? How have they taken into that consideration? So it's very hard to say that I know better than the founder does.
Right.
I can make a judgment call just based on generic quality of the book and say, this makes sense or doesn't make sense. But just from all the sort of fintech lending businesses I've seen, or a little bit of the banks that we don't see but hear of and see their numbers in the public domain, we've recognized that there's a reason you say creditable and not creditable and what that market is. Okay. And it's not easy to figure out what that, as I said, that loss ratio exponentially goes up without us realizing it.
Thank you.
Yeah, so my perspective is also very similar, that there are definitely, tenets of conservatism that fintechs can borrow from the banks. I've seen cases where, the fintechs have gone overboard and they think that only a proprietary algorithm is all it takes. And many a times for that segment, it's not the right approach. So wherever I've seen, value creation happening, I've seen the founders are open to maneuver their way to reach that optimal kind of workflow. And that workflow may not necessarily be completely in-house. It may require specialists for doing special things in that workflow, right? So you don't have to build everything or in-house. If you try to do that, that becomes very cost inefficient and time intensive. So I think that segment will require iteration. There is no easy answer. A lot of people have experimented different models. Unfortunately for us in India or even regionally, there have been macro events which have come in, so that have shown a very different picture. These are, macro headwinds where nobody can preempt and prepare for it. So unfortunately, what could have been a simple scorecard, it's not that simple anymore, because when you have such macro shocks which keep happening again and again, and I manage, Sri Lanka also for Aavishkaar, so you can sense how familiar I am with macro shocks. This process is an iterative process. The algorithms will have to become smarter. There is no denying the fact. I think one of the vantage points which FinTech should definitely maintain is that when they are doing that first level scrubbing of data, they should feel that they are at least somewhat intelligent about that customer. And after that, they have to read different signals to understand where are the melons, where are the oranges, and take their bets in a very calibrated kind of a manner. And it will require iterative process. It will require profiling, reprofiling again and again to reach a place where you feel comfortable that you are a prudent lender. That's my view.
So I know Tarana is focused on India, but her group does have non-India funds, including Southeast Asia focused funds, and they have a dedicated China fund, I believe. And obviously, you have involvement in non-India funds as well. What about, there's a lot of talk nowadays about FinTech in other parts of Southeast Asia, what's happening in Vietnam, what's maybe happening in Sri Lanka. And that's the big story for the Western world. India is a part of it, but now it's other parts of Southeast Asia, right? So what do you think? And I guess, Tarana, you can talk from a non-India perspective in terms of maybe the US because you spend time there, or any other geography that you can relate to. What makes, apart from the, I guess, the population and the macro, and that plays a big role, but what else makes India unique when it comes to FinTech? And the way these businesses are growing or being founded or surviving. What makes India unique?
I think, just UPI alone makes us unique, right? We're way ahead of anyone in terms of how payments, peer-to-peer payments are done, and what NPCI is doing, and I think ONDC is doing. So I think that alone puts us on the map. I think we're way ahead of the West, and even, parts of Asia are actually trying to catch up with us, but as you pointed out rightly, the markets are small relatively. So I think population, as you pointed out, just the tech development that's happening is a huge, just the government, I would say over here, even though I'm not a big fan, the government push has been commendable and puts us in an advantage. Also, just from an innovation perspective of what I'm seeing with some FinTechs, some very early days, but if they are able to execute, I think would sort of also give us a huge advantage on, and the awareness just generally with the population and what's happening in terms of aspirations, savings, awareness to sort of investing and insurance and those aspects.
Yeah, so obviously, as Tarana mentioned, public infrastructure is of a very different level in India. And second is talent. We are way ahead. If you compare Southeast Asia and India, so I've worked extensively in Indonesia as well. Indonesia has around 25 crore people. So one sizable population outside India. And that's where a lot of capital also outside India has been directed. China obviously is at a different level. So I'm not bringing China in the equation. But if you compare ex-China opportunities, Indonesia is the second largest, but where Indonesia is, I mean, in terms of opportunities, Indonesia has wide set of opportunities because their startup revolution only started about 5-7 years after India. So in terms of value creation, where you'll see a lot of unicorns emerging in the future, you will see Indonesia being right up there on the map. What is not so great over there is the level of talent availability, especially on tech side, and hence most of the later stage funded companies have Bangalore as their dev centers. So there is a clear realization that you require a certain quality of talent which is not readily available in those ecosystems, and hence many of those well-funded companies have brought in their dev centers either in a Bangalore or a Gurgaon. So we have a very unique advantage. India is a tough market to make money. Indonesia is easier to make money. Profitable companies emerge faster. Their bank NIMs are close to 8%. So as you can understand, making money is not that hard over there. Their ROCE of banks is at 35-36%. So from that angle, you know, a FinTech coming, disrupting, and creating value for themselves as well as for ecosystem, there are unique opportunities available out there. And a lot of Indian talent is actually utilizing it. Most of the founders you'll find there are from Indian origin. But India will continue to be like the leader of the pack. Something comes up in India, within 6 months something comes up in Indonesia. So you can pretty much draw the parallels. And there will be an Indian guy in Jakarta starting something. So we have played that role in that ecosystem.
Thank you. Can we talk, Shashvat and Tarana, a little bit about what's happening today, right? In terms of the slowdown, in terms of the slowdown in FinTech investments specifically, should we be comfortable assuming that it's just a cycle and it's just a correction? Should founders be worried and demotivated? I guess people like Tarana can keep busy in any case, right? Because the way you look at these businesses is a little different. And so do you have more people showing up at your door? I guess that's another question. How would you kind of define this phase? And what do you think is going to happen? I know everybody's guessing, but what do you think is going to happen?
So the short answer to your question is yes, there's a lot more folks opening to venture debt. But coming to, I actually think the slowdown was needed.
Yeah.
We had a lot of froth in the market. Valuations were out of whack. I know founders don't want to hear that, but the way I think if I was a founder, I'd look at it as, yeah, maybe I won't get the high valuation, but also if I believe I'm a good founder, I will actually get funded. So I think it sort of helps with the cleansing in the market where actually the right business models and founders will get funded versus anyone and everyone getting funded. So where we look at things more closely, I mean, I'm sure Shashvat will speak, you actually have time to evaluate the business, you actually have time to do your diligence, governance, figure things out, is this model make sense versus, being in a situation where it's like, I have a term
2
sheet,
days,
you have 2 days,
day.
give me another term sheet or we're done. And it was just good money going after bad. So I believe that it's a good phase. It gives everyone time to sort of breathe and figure out what they're doing. Even and for founders, right? I know so many founders who felt they were just on a treadmill trying to get growth versus now they can actually build their business the right way. So I mean, yeah, ideally not wanting to be such a drought, but as I said, it's not a bad thing. I was optimistic 6 months ago that this would be a 6-month sort of slowdown. But given what we're seeing in the environment globally, I would say maybe another year where it will take things to settle down, and I'm sure, and then things to pick up again. Now we can all be wrong and it's just a guess, but I'd say another year to sort of go back to, sort of a upward trend.
Yeah, I think I echo your thoughts. For us as investors also, you love the cycles or you hate the cycles depending on where you are in your journey. So given that I have a new fund and I'm deploying now, it's a good time for me. So can't complain much about that. But obviously, portfolio is in that mixed kind of a mindset of what you do. I mean, what is the gloom cycle that you can actually hope for? But I think, a lot of corrections were required there were a lot of excesses in the system. There were a lot of inherent assumptions that money will always be there, kind of thing, and that needed some degree of correction. It's not been easy, especially for people involved in the startup ecosystem. Unfortunately, that leads to cuts, and that creates a very difficult kind of environment, especially when you are trying to hold your team and grow. So the mental turmoil, apart from the valuation impact, the mental turmoil that it causes on the teams is also something that is very tough on the ecosystem right now. So we as investors, we are trying to hold it together and see how best we can maneuver this without really taking too many hard calls. If it's definitely not necessary, should we even go down that route? But hopefully, as Tarana mentioned, 6 months, 12 months, there is enough dry powder in the ecosystem. So and we are timed funds, so it's not an indefinite fund that we can just keep sitting on the money. So hopefully that force will kick in at the right time, and deals will start happening. Deals are already happening now also. It's just that it's taking a little more time. The check sizes have come down. The valuations have come down.
Okay, great. We're almost done. Just quick 2, 3, 4 word reactions to BNPL. One sentence, whatever your current point of view is. Tough. Shashvat?
Yeah, I mean, it's tough. There is no denying that fact. The book quality speaks for itself. So, I mean, we think that the world is partially online, partially offline in any case. Our world is a little hybrid to begin with. So we haven't really taken BNPL bets. But I think over time, people will realize that there is a role that the offline world plays and online world plays. And many online-only businesses have also gone in the omni-channel kind of a direction. So maybe it will lead to business models which are probably slightly slow-paced, but more prudent. But that is going to require the iteration that ecosystem is heading towards.
And lastly, AI and ChatGPT.
I think there's a huge opportunity.
Huge opportunity.
Yeah. It's evolving.
Yeah, significant opportunity, right? There's no, I mean, that is one of the biggest macro trend which is coming to the fore. And I think as with any optimization, I mean, when Google came, the level of activity on web went to a different level altogether. Similarly, if something like a ChatGPT comes to, comes in its full form and shape, many of the intelligentsia behind the businesses will definitely go to a different level. So big disruption, and we are hoping that everything, everyone is able to leverage it optimally and make their business models very, very efficient by virtue of that.
Okay, thank you both. I had a few more questions, but I think we're out of time. Thank you both for your presence.